Good morning, everybody. We're just going to give it another 30 seconds for people to join, then we'll get started. All right. Good morning, good afternoon. Welcome to the August 7Bridge webinar. I'm Justin Ferraccio, one of the partners here at the firm, and this is Chuck Eberly, the
What?
founding father, the godfather, who's wearing a camouflage shirt today. So if you just look for his head. So just to kind of kick this off, just a reminder for the new people on the call. This is kind of in lieu of us doing a newsletter. We thought it would be more fun, more interesting to do a monthly webinar, talk about timely financial topics. We will have guest speakers from time to time. I think we'll have a guest speaker next month. So kind of look for that next invitation that comes out should show who it is. It's not meant to be a replacement for your annual review meetings, specific questions for Chuck and I. In this meeting, you can feel free to ask questions to the chat. They come to me directly. We will answer them to the best of our ability on the call. If a question comes in that is specific to your situation, we'll reach out to you after. If we run out of time, we'll reach out to you after and kind of go through the questions in detail. But we'll go ahead and kick off. Let me share my screen. Anything you want to add?
Nope.
Great.
Proceed.
Helpful as always. All right. So today we're going to talk about records in the market, concentration in a market that we're starting to see broaden out. So quick agenda. So where are the markets today? We kind of go through that every time. What record highs have historically meant for the markets, concentration problem inside the indexes, evidence the market's broadening out, and what all this means for how we're building portfolios and thinking about investments through the end of 2026 and into 2027 at this point. So we'll quickly touch on year-to-date performance. So the Dow is now up 11% year-to-date. The S&P 500 is up 12%. The NASDAQ, which is more tech-focused, is up 14%. The Russell 2000, which is more small and mid-cap companies, is up nearly 20% year-to-date. And you can think of small and mid-cap companies as well as any private equity, private credit investments that we have for you kind of fall into that bucket. The equal weight S&P is up 15%, which honestly, I think the most interesting thing on this slide, there's a couple of things. One, kind of performance from July through August has been extremely strong. But what I want to point out is the equal weight S&P basically takes the 503 stocks in the S&P 500, and it weights them all exactly the same and shows us an average return across all 500 plus companies, whereas the S&P weights companies by market cap. So it's going to say, NVIDIA is so large that 8% of the S&P 500 is made up of NVIDIA. So it's weighted towards those big companies. So typically when we see the markets running like they're running now, it would be much more normal to see the S&P much higher than the equal weight S&P because it's typically driven by, the Mag 7, Google, Meta, NVIDIA, those companies kind of having explosive growth. So the S&P leaks up faster and higher than the equal weight. Equal weight is, again, a representation of all the stocks weighted equally. And so it's interesting to us, not surprising, but interesting that the equal weight is outperforming year to date.
I think, one thing to think back on, look back at 2023, 2024, 2025. We're going through these slides. The S&P was outperforming the equal weight by a wide margin. And so everything was more concentrated, the returns. So it's healthy and it's also, evident by the equal weight outperforming so far this year. So that's a good sign.
And then bonds continue to lag the market. Kind of at this point, the bond ag is down 2%, 2.5%. That's not a real representation of kind of short duration and tax-aware bonds that we're kind of using here, but it is showing that the fixed income market is certainly not keeping up with the market, and at this point is lagging substantially. And that has to do with largely tied to rates, which we can talk about later. So I think maybe you've noticed, maybe you feel the same thing we feel. The markets have felt a little calmer over the last month. What has caused that calmness? Calm is a maybe not the right word, but things haven't been as volatile. We're not seeing as many, 3% up days followed by 3% down days. It's been a little bit more consistent. And what's happening, earnings are carrying the market right now. Corporate profits, not multiple expansion, have done the heavy lifting. Right now, we're seeing about 85% of Q2 earnings reports beating expectations and many beating expectations by a wide margin. We've talked about this in previous webinars, and we'll get into it a little bit deeper here today. But, you know, profits are carrying the markets, positive earnings. A lot of that is tied to AI. Some of it's not. And again, we'll dive a little deeper into that as we go through the presentation. Inflation pressure eased in July. I think now we're looking at, CPI is 3.4% year to date. It was 3.5% year to date in June. We're now kind of at the coolest pace that we've seen since 2021, which was, just kind of early pandemic. And so inflation's in a much better place than it's been over the last few years. And then corporate buyback windows have reopened. So, you know, um, these windows open and close throughout the year. The last window opened August 10th. We're seeing $1 trillion of authorized repurchases already approved into August. It's the largest ever seen on record through this point in time in the year through August. We're going to be at 1.55 trillion by end of year in buybacks. And then just one thing to point out there is 70+% of the buybacks are actually coming from non-tech companies. So again, is showing us that there's strength in the market outside of tech.
One thing that's important about the buybacks, if you think about it, it's, supply and demand. If corporations are buying their own stock back, that creates less supply, increases price. So it's an overall big positive. Also shows confidence in companies buying their own stock back.
Yeah, and lastly, what it shows is companies can only do repurchasing if they have high amounts of free cash flow, right? So if companies are buying back $1.5 trillion of stock, sometimes they're retiring that stock, but they're doing that because they have free cash flows from earnings, revenue growth, all the different things that we discussed. So we're starting to get this question a lot, because we're at record highs now. We've been at, breaking record highs kind of pretty consistently throughout the course of the year. What does that mean? What does that mean for the market? Is that a signal to sell? Is it a signal of strength? We went back and kind of looked at the last 100 years. You know, um, 59 of those years, we had double-digit returns, so 10+% returns. 32 times we had those returns 2+ years in a row, and 11 times we've seen that 3 years in a row. And so what that kind of shows us is, these windows of explosive growth, they tend to cluster together, right? Just because we're hitting all-time highs doesn't mean the market is at a place where the price is too high. We've talked about earnings are supporting stock prices right now. It's just kind of the reality of where we sit. So we continue to kind of fall back on the mistake is not owning stocks at a record high, it's owning the wrong mix of stocks at a record high, right? So now is probably not the time to sit around and chase companies that have exploded with 100% growth this year. It's okay to own them. We've already owned them. We'll continue to own them, but maybe it's time to trim. But it's not a time to chase risk. It's a time to continue to chase value and look for these companies that are, you know, we think right place, right time. So the only way the market continue to break highs is continue to go higher, right? So it will continue to happen over the course of the next 5, 10, 20 years. We'll be having the same conversations. We're at all-time highs. It's just the reality of the market. We'll continue to set highs. We will have a pullback at some point. It's just when and what it looks like, and that's what we try to brace ourselves for.
Yeah. One thing to put some context into this, when I started in this business, the Dow was at 2,500 and it was making new highs. So for things to go higher, you have to make new highs. And just because you reach a new high doesn't mean it's time to, that things are gonna stop or slow down. It's just the normal course of things going higher. You keep making new highs.
We pointed this out a few different times, but we like to reiterate this point, right? Technology is now nearly 37% of the S&P 500. The three largest sectors account for north of 60% of the S&P 500. So when you just own the index, you're extremely overweight. We think you're overweight in tech, financials, consumer discretionary, and you're underweight other extremely impactful sectors right now. So just to kind of reiterate how we think about it, we want to own technology, we want to own AI, but owning it 37% is, where the markets are. We think that's too aggressive, right? And when you own 37% tech, it makes you extremely weak in other sectors of the economy. So just a very quick high level stream of consciousness of how we think about this kind of, coming into every year, we have these conversations and we might be closer to 20% tech. And that frees up 17% allocation where we've been, more heavily exposed to industrials, more heavily exposed to staples, energy, utilities, materials. And all those sectors have done extremely well this year. Tech has done well too, but these other sectors have done as well or better, which again, we'll show you kind of here in a second. But, 37% tech, and if you add back in communication services, which is 9%, communication services is largely Google and Meta, which is Facebook. And I could, have an intelligent argument with anybody creating the sectors that Meta and Google are essentially technology companies, right? So what you end up with is a mix that's nearly very close to 45 to 50% of your money in tech and AI if you're just buying indexes.
Yeah. Then you throw in consumer discretionary, that's mostly Amazon. So Amazon is consumer discretionary, but it's, Amazon Web Services, it's cloud, it's, I think what happened over time is those companies got taken out of the tech sector, put in the other sectors, but you almost have to count them back in. So you're almost up to 50% tech exposure with the index.
It's you.
It's me.
It's you.
I was butting in on you. I
You're
apologize.
good.
Okay, so there's definitely evidence the market's broadening out, meaning more than just tech providing us returns. So we talked about this earlier. The equal weight is keeping pace. Matter of fact, it's outperforming. So the equal weight, as Justin explained, just takes an equal helping of each of the 503 companies, and then that return, in recent history has not been as good as the traditional S&P 500 that's market cap weighted. The other important factor, every sector is positive. So there's 11 sectors of the economy. All of them are positive year to date. We were digging into the numbers on healthcare, which is kind of weak compared to the other sectors, but two companies, Merck and Gilead, had a write-off for R&D expense, and you kind of pull them out, and healthcare is right back up there. So strong performance from all 11 sectors. There it is, 11 out of 11. Year over year growth, 10 out of 11, 1 year earnings growth, 8 out of 10. So you look at that scorecard, that's showing a healthy economy across a broad sections of the economy. So it's a healthy sign for sure. Okay, one thing we will do is we'll kind of parse out these numbers. So we look at earnings growth so far this year. You look at the S&P 500, it's 50%.
Q2.
Q2. So just Q2. Thank you. 50% earnings growth. You pull out Amazon and you pull out Google, it's still 32.
And we're only pulling out Amazon and Google because they both had large one-time gains to their income, which won't be recurring, won't happen again. So if you strip out just kind of those two instances, We're still at 32% growth Q2.
Yeah. So 32%, that number is extremely high. Average is 7 to 10. So, you know, these, extremely strong earnings growth numbers is what's pushing the market higher. And also, you could make the argument that it's not expensive based on those earnings, but 32 is a good number.
This is year to date.
So year to date, 24%. You pull out Google and Amazon, it's 20, and there again, you know, almost triple average. Um, so we get asked the question a lot, why is the market, why does it continue to go higher? It's because earnings continue to go higher.
Yeah, and I think just to reiterate on this slide, what is interesting is this 24% number is counting the Mag 7. If you take the Mag 7 out, so it's Google, Amazon, Microsoft, Nvidia, we're still averaging 20% year to date earnings growth, right? So it's really just a 4 point spread now between everything together and then pulling out the most dynamic, fastest growing seven companies. So again, this kind of just continues to paint the picture of a broadening of the market and the Mag 7, which has been in the driver's seat for the past 3+ years, and it still is, but it's not as impactful as it has been historically.
Okay, so we kind of look at different sectors and the dispersion between best performing and worst. Communication services, showing a 2.8. Mainly that's because of Meta's performance. If you look at energy, I think you go to the gas pump, you'll understand why energy earnings have exploded. It's because of the price of oil. Um, Technology, that's a pretty simple story with AI. But you look at industrials, materials, those are beneficiaries of AI spending. Um, but I think, the point of this slide is to point out that, you know, we are overweight energy compared to the market in your portfolio. We are underweight technology and we are overweight industrial. So the fact that we don't just, fill up with the concentration of the index, it gives us the ability to get outperformance with less risk in these other sectors. But it's just, there is a wide dispersion. When you look at your accounts and you may look at that, well, why do we, let's own less communication services and more energy. It's all about managing risk. We want to get the returns, but more than anything, we want to manage the risk. So goes right into this slide. How do we build portfolios? We've hammered this over and over again, diversify by sector deliberately. Um, there are going to be companies and sectors that, don't fully participate in what's going on, but they are in there to provide ballast to the portfolio. The core of each portfolio is anchored by dividend growth. Characteristics of dividend growth is, company pays a dividend, grows their dividend every year. As a group, those companies are 30% less volatile than the market. So there again, that's another point of ballast. Control concentration risk. Don't want too much in any one sector or any one company. And then the satellites we use, whether it's to add growth to your portfolio or add more stability, they all have a purpose. Things to look for, or things that could change, this narrative. Federal Reserve meets in September, very much a bias towards raising rates a quarter of a point. And you look at the energy prices, Justin and I were just talking about that. We just filled up yesterday and we're blown away by what it costs to fill a tank. Um, that if that continues, that increase in energy expenses is going to filter into the consumer price index more and more. So that could change the picture. Um, Shaping up to be an exciting midterm, um, to say the least. That is definitely an unknown. Um, and everything going on with the war, which directly relates to energy prices. So this this scenario is not without risk or concerns. Um, but right now, the capital expenditure on AI is growing and continuing. That's the major narrative. You know, could the Fed stop that? Probably not. The midterm stop that? Probably not. Um, Energy and geopolitical events? Probably not. But they are factors.
Great. So just to kind of conclude here, and then I think we have a couple questions, so we'll pivot back into the chat. But a record high is not a reason to sell. Strong years cluster together. And this rally is, supported by real earnings, not just multiple expansion. We are getting, some multiple expansion, but it's driven for the right reasons. The index more concentrated than it looks. We probably said this in a lot of webinars now, so I'm sure we've hit this point, but tech is roughly 37%. Add back in companies like Meta, Google, Amazon. It's nearly half of your investment if you're buying an index is in companies that are directly tied to tech and AI. So owning is, not about owning the index, it's about owning the right mix. And the stock market's broadening out, and that continues to favor sector allocation, company specific allocation, and kind of all the things that we're taking care of on our side. And so I'm going to stop my screen share. Okay, that's a good question. So after pulling out the Mag 7 and getting back to 20% growth kind of year to date, how dependent is that 20% growth on Mag 7 spending? Which,
It's a good question and something that we look at all the time. So if you think about capital expenditure on AI, that directly benefits obviously tech, communication sector, industrials, utilities,
materials.
materials. So direct relationship there. Sectors that don't necessarily have that are financials. They're primarily pricing on the interest rates. The fact that rates moving higher, banks have better margins. That's why we're seeing the strength with the financial markets. Healthcare, here again, not a direct beneficiary yet of the AI spend, um, and consumer discretionary. So those things kind of stand on the strength of the economy or other factors. So one thing to look at the capital expenditure, um, the rate of that spend has far exceeded the increase in revenue. So that tells us it's not sustainable. You can only spend more money without making more revenue for so long. Right now, there's no end in sight of that spend. So something for us to watch, um, is is that spend slowing down? That would be a sign that things um, are slowing and could be trouble with earnings. Um, we're also watching to see does revenue increase at a similar pace to the spend. If that happens, then this is more sustainable. So what we're looking for is signs that it's slowing down, stopping. Um, for right now, there's no sign of that slowing or stopping.
Yeah, it's a tough question to answer with a mathematical solution, but to Chuck's point, CapEx continues to drive the market, right? So that 20% earnings year to date, 20% growth of earnings year to date, it is largely driven by CapEx, which is largely driven by AI spend. But even if you peeled that all out, you know, I could do the math. We're still going to be growing faster than the average growth rate. But again, CapEx is important, and the real question is, at what point do the companies spending all of this money start to realize revenue and profitability from the spend? And they haven't yet. right? But they're also not slowing down. And so to us, again, that's a trigger that they see the writing on the wall that that the juice is worth the squeeze. The spend is worth the reward down the road. If that starts to slow down, if they start to realize that may not be true, that'll be a major inflection point and a trigger to us. So that's something we pay very close attention to. But that's a good question. That's the only question we got. So if there's any other ones, send them right now or just reach out to us directly. But as always, we appreciate you spending some time with us, and hopefully you find this helpful or entertaining. And we'll look forward to doing it again in September.
Have a great day, everybody. Thanks for joining.
Bye.
Bye.